Hello.
Hello.
Hi.
Who
Can
am
you
I
hear and
speaking?
see me?
I can.
Okay.
Looking good.
Thanks. All right. We'll start in just another minute.
Always interested to learn more with QuickBooks.
Yeah. All right. Hello, Dave.
Hello. And you're Angelina?
I am.
Okay, very good.
Yes. All right. So we have about one more minute.
Didn't know whether Zenobia was going to be on the call today or not because I know she was resting.
Yeah, Julia mentioned she wasn't feeling well.
Yeah.
But
Okay. Okay, so it's 3:30. I guess we'll go ahead and get started.
Okay.
All right. So for the first portion, I'm going to share this. Okay. Okay, so today we're going to have a little Quickbooks presentation. And I am Angelina Evans, and I am at Shannon & Associates. So you can reach me at aevans@shannon-cpas.com, or our number here is 253-352-8500. And just a little bit about me. I've been in accounting for, goodness, 23 years now. So started back in '97, and I graduated from Florida Gulf Coast University in 2002 with my bachelor's in accounting.
Okay.
And then took some time to raise my kids and graduated with my master's in accounting in 2011 from the University of South Florida.
Okay.
Yeah. And then we moved out here to Washington in 2015. So we've been here for about 5 years and really enjoying it. It's beautiful here. So I've been at Shannon & Associates since September of 2017. So
Okay.
coming up on 3 years before we know it. All right. So I would like to go ahead and start with QuickBooks Desktop versus QuickBooks Online, which is best. And then after we go over some differences between the two different softwares, I'll go through a brief QuickBooks Desktop demonstration, and then we'll have a QuickBooks Online demonstration. And then we'll have some time at the end for any questions people may have.
Okay, that sounds great.
Okay. Okay, so QuickBooks Desktop. Some good things that I've enjoyed with QuickBooks Desktop are the ability to access it anywhere, even if you have an internet connection. That's always nice. There's no monthly fee like with QuickBooks Online. And you can have multiple company files in Desktop. You can have unlimited company files. You can only have 3 licenses. So you would be able to have 3 users, 3 computers, 3 licenses. So that can be a little bit limiting sometimes. So some cons with QuickBooks Desktop. So the software is only supported for 3 years. So there's been some times with some clients where they've purchased the software like QuickBooks 2016, 2015, and then it stops being supported after a while. So they can run into some problems with that. Another disadvantage is you can't track locations. So let's say you have cells in Washington and California and Oregon, you can't track locations. You can use classes, but not locations.
Okay.
And then the backup isn't automatic like it is with online. So you need to remember to back up your company file so that you don't lose days worth of work. Also, it needs to be updated often. So there's different updates that it'll prompt you to go ahead and install. And it's also unsupported. So you buy it, but you don't get the support. You have to pay extra for the support, which can add up over time.
Yeah.
All right, so QuickBooks Online. It really seems like QuickBooks is pushing everybody toward their online software. Pretty much anytime you look for a question about QuickBooks Online or need support, it pushes you to the online site. So I think that in the future, they're going to be advocating more for people to do the online versus the desktop. Some good things about it, you can access the software anywhere, even on your phone, which can be really helpful. If you're not near a computer, you can still log on and check your bank balance or, look at your profit and loss, see where you are anytime that you have an internet connection. Support is included in the monthly subscription price. And with online, you can track locations and classes. So one good thing about class tracking, you can have an administrative category, or you can have a sales category. You can record your income and expense through the classes, but you can also track locations. So you could have your admin, sales categories of classes. You can also track it for Washington, Oregon, Idaho, California, which is really helpful to have both. Another really good thing about online is that you can share your file with your accountant. So you can set up an accountant user, and then the accountant can log on to the QuickBooks file the same time you're logged into it, which has been really helpful for me and my clients because we can be looking at the same thing together no matter where we are. With desktop, you need to do a accountant's copy backup or just a regular backup and give it to your accountant. So with the accountant's copy backup, there's a little bit of a lag from when you create that file because you have a dividing date. So you can work up to, or you can work past the dividing date, and your accountant can work up to the dividing date. So it locks you out of history while the accountant is working on it. With online, the accountant and the client, or you, can be in the file at the same time, which is nice. With online, the backup of the company file is automatic, and the software updates are also automatic. Another great thing about online is that you can sync your file to your bank and credit card feeds. So you can download your bank transactions and then receive them into your file, which also really helps for reconciling your bank account later on. Because with online, it goes ahead and clears off what you've downloaded and received. But often when you go to do your bank reconciliation, you're already there. You go to open it and it's already at zero difference, which is nice. So some cons to online are that it does have that monthly cost. So instead of paying the one-time subscription price of $300, you're paying each month. So speaking of cost, for QuickBooks Pro, there's a $300 one-time payment for the 3-year license of up to 3 users. And you can also add support. Support is $300 a year. If you wanted to have unlimited support, it's $150 for the first year and $300 after that.
Okay.
So for QuickBooks Pro Plus, that would be the $300 a year. So it's more of an annual fee instead of a one-time software fee.
Yeah.
For payroll, it's $29 a month plus $2 per employee. And you can run the payroll, but that $29 a month won't really let you prepare the payroll reports that you need for your quarterly and annual filings. You'd have to move up to the enhanced subscription. So that's $45 a month plus $2 per employee. And then with that, you can run payroll and prepare your reports. With the assisted, you submit your payroll or your hours to QuickBooks and they handle everything. So they're going to prepare your payroll, they're going to run your reports. They even have a guarantee where if the payroll has been filed and comes back with errors, they'll fix it and they'll also take care of any penalties. You also get access to payroll specialists, which is really helpful. So with online, the simple start is $25 a month. You can have one user, And it's good for basic accounting functions. It doesn't have a whole lot of reports. You can't track inventory. It's just a very basic software.
Okay.
Yeah, you can access basic reports like the balance sheet, the profit and loss, but it is more limited. So when you go up to the Plus, you get 5 users. It's good for most accounting functions. You can track inventory in the Plus, and you can track classes and locations and have class reports. So with classes, when you do a profit and loss, you can run a profit and loss by class and see the individual income and expense for each different category that you want to track, which is really nice.
Okay.
It's been really good for clients that have had real estate. They can set up a class for each real estate property that they own and see the rental income and then the rental expense per property, which is really good.
Okay.
The advanced subscription, you can have up to 25 users and you get a dedicated account manager and you can have online training. So it's, you know, all-inclusive service. It's the top of the line for QuickBooks Online. For any of these services or any of these subscription levels, you can add on payroll. So the basic is $45 a month plus $4 per employee. And you can file your reports straight from QuickBooks. So when it's time to do the 941, you can just go right into QuickBooks, review your 941 and submit it. You can also pay your EFTPS deposits through QuickBooks. For the premium, it's $75 a month and plus $8 per employee. And you can track time and you have access to more reports. So if you're in QuickBooks and you enter time for an employee, say John spent 5 hours on the Madison landscaping project, it's really neat that you can track time that way. And then with the Elite, just like with the desktop, QuickBooks Online has a all-inclusive package with the Elite, and you get access to an HR specialist, which is great because they'll even help you write job descriptions.
Jeez.
Yeah, it's kind of like having your own HR person. And they'll help you resolve filing errors, pay your penalties and fees. And then you also have access to payroll professionals through that.
Mm-hmm.
So there's different levels. You can pretty much pick however much you want to spend, how much service you want to have. They'll have something for you. Okay, so I'm gonna stop sharing my screen.
Okay.
Does anybody have any questions so far?
I know for me, one of the things I ran into, because I just had to trade up my update my QuickBooks, and I faced the desktop versus the online version.
Mm-hmm.
And I went ahead and got the desktop again simply because I was told that you couldn't transfer your past information to the online version.
Wow, no, you can totally do that. I'm surprised somebody would tell you that.
Okay, I was told that I couldn't automatically transfer things. I would have to re-log it into the
Yeah, I actually worked with a client to transfer their information from desktop to online, and it went really well.
Okay,
Yeah.
I'll remember that next
So
time.
for the future, if you want to go back to online. Okay. So if there aren't any more questions, I'm going to go through, let's see, let me go through desktop. Okay.
Hello, can you hear me?
Hi, I can.
Okay, we have a question for you. We've never borrowed money, but we got this payroll protection plan.
Mm-hmm.
How do we enter that? What do we create as far as a category to put it in, and how do we handle it when we pay it off?
Okay. So with the PPP loan, the best way to enter that right now is going to be as a current liability.
Okay.
So you're going to want to go in, and I can, do you have desktop or online?
Desktop.
Desktop? Okay. So I was just going to go to desktop. So let me go ahead and share my screen again. And let's see, I'm going to go here. Okay. Okay. Can you guys see this?
Yes.
This QuickBooks? Okay. So you're going to want to go into your chart of accounts and just do a new account. And we're going to call it a current liability because it hasn't yet been forgiven. You're going to need to go through the steps and submit the application for the forgiveness. So we're going to do a current liability, and we can call it PPP loan. And then when you record that, so you probably have already received the deposit.
Correct.
Okay. So the way I look at QuickBooks is probably different because I look at it from the eyes of an accountant and tax preparer. So the way I get to the bank account
There you go.
is
Thanks.
go through the balance sheet. But we can go through the register. Okay, so let's say
Young man, huh? Yeah.
it's here in your checking. So you'll want to just go find the transaction. See if I can get to the register. Okay, here we go. So I just did Control R to get to the register. Okay, so you're going to want to go ahead and find it here in your register and then just reclassify it to that current liability. Did you deposit it as like revenue, or is it just sitting in there for now?
It was wired into her account or direct deposit into her account. So
Okay. So yeah, if you just go find it, it probably was received as a revenue, or have you not yet entered it?
have you entered it into?
Yeah, I entered.
Oh, yes, it's been entered.
Okay. All right.
Let's
So
do an individual thing. Let's do,
Yeah.
okay. So yeah, you can just go find that deposit and then record it as a current liability. So when it comes time to pay, or when that loan becomes forgiven, because right now you're recording your income and your expense normally.
Right.
So when that loan is going to be forgiven, you're going to go ahead and do a journal entry. So you're going to want to go up here to company and then make a journal entry. And you'll date it for whenever you need. And then you're going to go find that PPP loan. And then you're going to want to debit it for the amount that you get forgiven. And then you can come down here and credit non-taxable income for now. There's a little bit of debate regarding whether or not expenses are still going to be allowed for the PPP loan. That's kind of ongoing. So once we have the guidance for that, we'll know if we need to remove the expense. So the best and safest way to do it now.
Now that they've extended the time,
Yeah,
the
to
payroll will
24
certainly
weeks.
cover the loan. So I don't think that'll be an issue for us.
Exactly. Yeah. So when it's time to be forgiven, you can just come and even do a new account. So you could go back to the chart of accounts and just do a new account for other income. And then we'll just do non-taxable PPP. So you're going to want to debit the amount of the loan forgiveness and then credit the amount of the non-taxable to get it out of that current liability account.
Oh, you're debiting it out of the liability account. So in effect, it's a positive. It's not a negative. I mean, on the overall.
Yeah, because the liability account has a credit balance normally.
Right.
So when we debit it, it'll take it out of there and remove the balance from that account. Yeah, so it'll be like 200 or however much. And then you can just add a memo to make sure that you can track it and everything.
30 years, I think it is, if you want it.
For the loan?
Yeah, but we won't do that. So
Yeah, I mean, I've been putting them in as current liabilities for now. If it's determined that it's not forgiven, then you could always change it to a long term.
yeah, no, it'll be paid off. And
Yeah.
I can't refuse free money. So
Well, exactly, especially when everybody's struggling.
No,
This is,
it's liabilities. Okay.
Okay. So are there any other questions about that for now?
No, I think,
No? Okay. Okay, so one of my favorite things about desktop is to come over here and do view open window list, because over here on the left hand side you can see where you're working, because if you don't do this open windows list, I mean, you're kind of just pulling up windows, you know, and a lot of duplicates can get pulled up, which makes your screen kind of cluttered. So let's go ahead and open this back up. Okay, so this is just a sample company file, so we can look around in here. Okay, so let's say you have inventory. So a good place to go to set up inventory is going to be here in this item list. So you'll see that, so here's some quantity on hand here. So you can go here and do a new item and set up your new item that way, but we'll just open this one to look at it. So, okay, so we've got an inventory part, we have the name, and when we're going to sell it, we can go ahead over here under cost of goods sold and assign it to the cost of goods sold account. When we add it to our inventory account, and we can set it up as taxable when we sell it. So when we go to sell one of these, we can go to create an invoice, and you can pull up your inventory item. Oops, that one doesn't, we don't have any of those. Let's try that one. Okay, and then you can pull up your inventory item, and it kind of handles your whole inventory system for you. So after you enter your items, and then when you go to invoice one, it'll take it out of inventory. It'll add it to cost of goods sold when you sell it, and it handles all of those transactions, which is really helpful. If you set up your inventory properly, it can really help keep your records clean. Because sometimes what I'll see is this inventory account will be really high, which is not accurate. It's inflated because the inventory hasn't been moved to cost of goods sold.
Okay.
So that's one thing that I see that could be improved sometimes. Another thing that's good to keep in mind with QuickBooks is the fewer accounts, the better. Because when you have too many accounts, it can be really confusing which one to use. It can look really bad on your profit and loss and make it really hard to read, which makes your reports not very usable for what purposes that you need them. So when you're setting up new accounts, just make sure you really need that account for tracking. One good thing to do right now, because entertainment is no longer deductible. So before we would just have like meals and entertainment. Let's see if this even has meals and entertainment. No. So we need to have meals separate from entertainment now. So that's a good thing to keep in mind if you haven't already done that.
You'd have no what? I'm sorry.
Just to keep entertainment separate from meals, because entertainment is no longer deductible.
what's the bills?
Yeah, so those two items need to be separate now. So you need to have a separate account
Which
for
bill?
meals.
I'm sorry. One of them was entertainment. The other was,
Meals, like,
oh, meals. Okay.
yeah, sorry. I still have just a little bit of a Florida accent.
Meals are still deductible to
50%.
50%. Okay.
Yeah, entertainment is not deductible at all anymore.
Huh. That's not fair.
It's not, is it? Because it's a legitimate business expense.
Usually meal and entertaining, they are together.
Yeah, but they've changed it now, so
So I need to separate
entertainment
them.
is no longer
So I
deductible, she
need to
said.
separate them.
Okay.
So question, when you're talking about wanting to have as few accounts as possible, what if you wanted to set up different set-aside accounts within your savings account?
Well, if you're talking about bank accounts though, those definitely need to be individualized. So let's say you have one
Yes.
savings account,
Mhm.
but in your QuickBooks, you wanted to break it out into categories comprising the total.
Right.
I mean, you could set up sub-accounts for your savings account and then collapse them, but it would still be really messy.
Okay.
So if I were to go into here and let's see, where's my bank? Okay, so let's do a new account. And we're gonna set up savings 1, make it a sub account of savings. And let's say we have savings 2 and make that a, oh, no, go back to savings. And let's go to 3. Okay. Okay, so we have all of these accounts. Oh, nuts. Okay, so we have all of these accounts now. When we go to the balance sheet, let's see. Okay, oh, because I have no balances in them. Let's do a journal entry. So I'll show you the difference of how it will look here. That's it. Okay. Oops, sorry, that was really loud. So see the difference? See how this looks? I mean, you can see all the different balances in the savings, but it's not as user-friendly to look at.
Okay.
And it would be the same thing for a profit and loss. So if you were on the profit and loss and like this, under auto, insurance, fuel, maintenance. I mean, do we really need all of those accounts? If I was gonna do anything, I would probably just put insurance under insurance. But then again, I look at QuickBooks from the eyes of a tax preparer. So I know that on my tax return, I have one line for insurance. So I don't know. It just looks kind of cluttered, which is why it's a good idea to keep the accounts minimal. So,
Another question.
okay.
I'm sorry, I didn't mean to cut you off.
Oh, no problem.
We've recently received a rather large, we've issued a rather large credit to a company. In other words, we took a buyback of the
Okay.
merchandise. We're overstocked, we bought it back. So we've issued credits. How do we handle that in QuickBooks? I mean, mentally, I know that the credits will be reduced by the invoices of future purchases.
Uh-huh.
That's the deal. They can't get cash. They're just going to get merchandise. So how do we set that up in QuickBooks so that it will, as we issue invoices to these people, it will reduce those credits? Where do we put the credits and how does that work?
Okay. So you have these people set up as your customers in QuickBooks.
Yes.
So you're going to want to go up here to the customers, and then you can create credit memos down here. So you're going to pull up a customer, and you can just date it. And then here you can even, was it like it was a merchandise? So it was an inventory item or?
Inventory item.
Yeah. Oh, that's one other thing too. This customer has a series of warehouses and the credits are tied to those warehouses. In other words, they can't just lump them all together and buy for one warehouse.
Okay, so do you
As
have
the warehouse. So those warehouses are like individual customers.
yeah. Okay, so you would have the main customer like this. You would have the main customer, and then you would have sub
You'd have subs, correct?
little locations here, or jobs.
Right.
Okay, so you could just select what you need here, come down here, and if it was an item in inventory, you could receive that inventory or that item back. If not, you would just put a description here for whatever it is that you received back. And then you would need to just put the amount here. So the item is going to be tied to the account. If it's not an inventory item,
Inventory
Yeah, it's
item.
a standard
It's an
inventory
inventory.
item.
it is. Okay. So then you could just select your item description and then the amount that you're receiving back. And then when you save that, it goes into their accounts receivable as a credit. So then when you write the invoice, let me see if I can just do one here.
When you enter this, you need to enter
Let's go to the candy shop. Okay,
get the inventory back.
so we're gonna have,
Well, first you're entering a
let's
credit
go
memo,
here, okay, 55. Okay,
each warehouse.
so I'm gonna create this credit memo for Adam's Candy Shop. Save and close. I'm gonna retain it as an available credit. So then when I go in here to customers and create my invoice for Adam's Candy Shop, okay, so I'm gonna invoice him let's do that one design, okay, $55. Okay, and then, let's see, I'm gonna go and apply his credit.
Where are you?
Oh, it's
doing
up
that?
here, apply credits.
Oh, okay.
Means that later, when they purchase again, it's invoice.
Okay, so I'm gonna record my
An
change.
invoice that she's going to apply the credit to.
Right.
Yeah, so here's the apply credits. And we're gonna record that invoice. And then see how it takes us almost to the payment screen when you go to customers and receive payments? Then you can just apply this credit.
Oh, and it would show then the available balance. If the credit was more than the invoice, it would show an available balance there, credit balance.
Exactly.
Okay.
Yeah, let's say, or I could have had that invoice be 110, and then this would be 55, and then credit balance would have been 55. And then when we go to this invoice, see it says paid. 0 due for the balance down here.
That'd be the later,
Mm.
later when they purchase.
Okay,
Yeah, when they purchase,
like
then you
that.
create an invoice, you go to apply credits, and it will
Yeah.
reduce the credit.
okay. So does everybody know how to go into reports and customers and look at their accounts receivable?
Mhm.
Okay, so then this is another good way that you can check to see what everybody's account looks like. So one thing that I've noticed a lot about the accounts receivable aging summary, so if you receive a payment, let's say you receive a payment for something that the customer has purchased for you, but you didn't have an invoice, it's going to show up in here as a negative. So let's say you received $80 from Adam's Candy Shop. And let's see, where's receive payments? Okay. So if you receive 80 and it pays for this, but let's say you forgot to do the invoice. Okay, so see how he has a negative?
Yeah.
So a lot of times people receive payments, but there's no invoice. So it kind of throws off your accounts receivable and your income. Because instead of showing income, it's going to show a credit balance in AR. So that's another thing to be careful about when you're, let's see, if you
Now,
go
those
to,
credit balances would not have anything to do with the accounts receivable aging, right? It wouldn't affect this.
well,
screen.
it would show a negative.
So you
So
would show a large negative then.
it could get
which
to be
would
very
make sense,
large,
I guess,
yes.
yeah. Well,
Yes.
I'm thinking of ours, it's a large negative, so.
Yeah, so it will be a large negative. It's going to show that in your AR aging summary, but that's accurate. I mean, you have a credit memo. So you just, when you're receiving your deposits, just be careful to make sure that there's no invoices that need to be applied to the deposit and that it's revenue when you receive the deposit, because if you receive the income without the invoice, it's not going to affect your profit and loss correctly, and then your accounts receivable will be thrown off. So just to keep that in mind, if you look at your accounts receivable summary and you see a bunch of negatives, it could be because the payment wasn't received properly. Okay. So when looking at the profit and loss, you can customize this report to show you what you want to see. So you go over here to customize report, and you can toggle back and forth between accrual and cash. So the cash is going to show you the money that you have actually received. The accrual is going to show you the money that you've earned. So if you have invoices, they're going to show up in accrual income, but not in cash unless you've received the payment for those invoices.
Can you explain a little bit about the accrual and the cash, the difference?
Sure. So with accrual, you're going to have invoices for your services, and you're going to have bills for things that you owe, things that you've purchased. And if you're on the accrual basis, it's going to show up in here on the profit and loss, whether or not you've been paid for it for the income and whether or not you've paid for it in the expense. So if you want to get a picture of what you have actually received in income or paid in expense, you're going to want to go over here to cash. So this is going to show you, I just want to see real quick how far out this goes. Okay, so this is all 2024. So let's say to 31/24. Okay, so from January to March 2024, on the cash basis, we have actually been paid for $8,262. But on the accrual basis, we've invoiced $5,518. So the difference in cash and accrual, that $3,000 difference, means that we probably received some 2023 income in 2024 because what you received was higher than what you invoiced. So it's the cash that you've actually received versus what you've invoiced.
And which do you pay taxes on? Cash or accrual?
It depends on how you file, actually. So as a business, if you file on the accrual basis, you would pay tax on what you've invoiced versus what you've received. If you're on the cash basis, then you'll pay tax on the money that you've actually received. So for small businesses, cash is probably a good idea because you have the money to pay the tax. If you're on the accrual basis and you have all of these invoices but haven't been paid yet, you're going to pay tax on what you've invoiced, even if you don't have the money in hand.
But isn't that true also of your expenditures? In other words, you come up to the end of the year and you say, oh, maybe we got to buy all of this stuff right now. We may not pay for it until January. Those would be deductibles, correct?
Exactly. So at the end of the year, let's say you want to enter a bunch of bills to have some expenses, but you haven't paid them yet. You're right. We would have to adjust those out of the cost of goods sold to reflect what was actually paid. Yeah. Okay. So, oh, go ahead. Oh, I thought I had another question. Okay. So another thing to watch out for in QuickBooks. So when you go to do your reconciliation, let's see if this has, and it doesn't have any prior ones, which is too bad. So let's say you go to do your reconciliation. If you scroll to the bottom of that report and you have uncleared transactions, you need to be really careful about those old stale transactions because they're not paid, which means, or they never cleared, which means that you probably have expenses that actually need to be written off or income that might need to be written off. So just be sure to watch out for uncleared transactions when you do your bank rec. That's another thing that we kind of look at the end of the year when we prepare tax returns. Okay, so let's see.
Question again, if you don't mind. If you take out a what amounts to a bridge loan, buy a piece of property, and then 3 months later you pay it off because you've sold another piece of property or you got some cash in, how do you account for that? Is that something that needs to be accounted for? You took out a loan at no interest from your dad, and then you paid it back. Is that something you could just eliminate from the statement, or?
No, you should really keep track of it. So if on your side, you're the one taking out the loan,
Right.
so you would go in here to banking and make a deposit. And then over here, you would record some kind of current liability because you know you're gonna pay it off in 3 months. So you could set up a new current liability and then record the amount that you received. So when you go to this screen, banking, make deposits, the amounts are recorded as credits. So, okay, so let's just do loan from dad. Right, and we're gonna call it a current liability because we know it's gonna be paid off in 3 months.
Loan.
Make the deposit, and you set it up as a current liability.
Mhm. Okay, let's say dad loaned us $50,000. So we're gonna save and close that. And then when we go over here to our balance sheet, there's our loan from dad, 50,000.
Right.
So when we're ready to pay that back, we would go to banking and write checks. And then we would come over here to account and look up our loan from dad. Because when you go to banking and write checks, all of these transactions are going to be debits. So, sorry about how loud the beeping is. Okay, so see, our loan is gone. So that's how you would keep track of it, but you should record entries for that because it's going to hit your bank account. And if you don't record the entries, when you go to do your bank rec, you're going to be off.
Oh, yeah, you have to reconcile.
And you want to make sure you can track everything that happens in these accounts.
So obviously it goes in first as a deposit,
It does, yeah.
and
So
that's
banking.
loan to dad. Then you go into
Ready.
your,
Write checks.
I mean, before that, you still have to go into your
Balance sheet.
liabilities
Yeah.
and list it as a liability, right?
Yeah, you could set up a liability for it.
Okay, and then when you pay it off, you write a check, and
Uh-huh.
go back into your liabilities and debit the liabilities to get rid of it.
Mm-hmm. Yeah, make sure you clear it off.
Okay.
And don't record it as an expense. Okay. So another thing that's helpful sometimes if you want to work with information. So let's go to reports. Let's say you want to pull up a general ledger for 2024. Okay, so this is a lot of information, right? So if you want, you can export this to Excel.
Mhm.
I don't know if everyone's used this or not, and then just do it in a new workbook.
Yeah, but not from general ledger. I did it generally from other reports that I'd pull up and go into Excel to Excel.
Yeah. Oh, this was probably a really bad example to export this journal ledger. It's going to be huge. Sorry. Okay. So yeah, you can always.
Well, we have a function in a computer that tells us each item, how much we sell each month.
Uh-huh.
And that I'll generally go into Excel and then extend it over a year and come up with my average sales on that item. So I can set up my purchasing expectations from that.
Yeah, that's awesome.
It's great to be able to export it to Excel.
It really is because you can really work with this data now. You know, you can filter it, you can sort it, you can do all kinds of stuff with this data. So I just wanted you guys to see.
That was very helpful in lawsuits.
I bet. Okay, so we've gone over just a couple of reports here. Profit and loss and balance sheet, accounts receivable. I think I'll probably move on to QuickBooks Desktop or online, unless anybody has any other desktop questions.
Interview.
No?
I'll have a
Okay.
Question?
End of the year, any particular processes that we should be going through? Is there something to be done before I turn this over to my CPA to give me the bad news, or how do we?
Well, one thing I like to look at, so when I get a new QuickBooks file and I'm getting ready to prepare the tax return, I go through the balance sheet first. So I want to check to make sure that each of these accounts are reconciled through the end of the year. And when you're doing your reconciliations, of course, double check your old outstanding transactions and make sure that there's not a whole lot of unclear transactions. And if you see that there are, so one really good report to look at, and of course this sample file doesn't have the bank recs, but if you go to previous reconciliation, so see this button down here, transactions cleared plus any changes, that's the best one to use because it'll show you if anything has happened since the reconciliation.
Okay.
And then you can kind of tie it out here to your balance sheet, to your cash balance to make sure that they agree. So when you're doing your bank rec, and if you see that you have some old, stale, unclear transactions, don't click on them and void them, please, because that's going to throw off your retained earnings. Let's say they're from a prior year and you just void that transaction. It's going to mess up your opening balances for your accountant. So that could be something that you work with your accountant to clear up, because the right way to do it is going to be to make journal entries to get rid of those. You don't want to just void.
Okay.
So check your bank recs against your cash balances. See your accounts receivable. You should probably go here to your accounts receivable summary and just quickly browse through your clients. Make sure they look reasonable. Is anything over here in the greater than 90 days? Is that going to be collectible? Those are all things that you should be talking with your accountant about as well when you're getting ready to prepare your tax returns.
At what point can you write those off? Is 90 days a reasonable point to say this is probably not collectible, even if you do collect it in the following year?
Yeah. You know, you should really write them off once you have determined that they are uncollectible. So if you're looking for your clients and you know that you have a client that's not going to pay you, go ahead and write that off. But if you have one that's kind of questionable, maybe you should leave it there. So it kind of just depends on the clients, with your history with the client, whether or not you believe that they're going to pay you. Because let's say that you do write it off and then you collect it the following year, you can always record that income the next year. So
if you're having a good year this year and you're not expecting it this next year, then you've got an option there, as long as.
I don't know about that. That's a little bit too manipulating for me, I think. Yeah. So if you believe that they truly aren't collectible, then you could talk to your accountant about writing them off.
Okay.
Yeah.
Any other end of the year things to look at?
You might want to check out your payroll liabilities and make sure that those look accurate, because a lot of times when people are paying their payroll liabilities, instead of clearing out the liability, they put that whole payment to expense. And of course, that payment includes the employee's share of stuff as well. So when you're making those EFTPS payments, they don't all just go to expense. They're going to clear out the liability account. So that's one thing to look for. If you just open up your balance sheets, if you go to reports and then company and financial and balance sheet standard down here, and if you
So
look
those-
through these accounts, check them to make sure they look reasonable.
So those payroll liabilities include both the company's payments and the employees' payments?
That's right.
Oh, didn't realize that. Okay.
Yeah.
So yeah.
Yeah, so when you write the check, the company's portion of the expense will go to the profit and loss as expense. And then the company and the employee's portion sit here in payroll liabilities until you write that check to clear out this account.
So then if you look at your profit and loss, will that show differently? Or is payroll liabilities even part of it?
Well, it is, because half of it is your expense.
Hmm.
So half of it goes here in payroll expense. And then the company and the employee's portion, it all goes over here to payroll liabilities. So let's say you write a check for your payroll tax obligation to EFTPS. And instead of clearing out your liability, you just write the check to EFTPS and you come over here to payroll expenses and record it that way. So that's going to overstate your expense. And in the meantime, this liability is just going to continue to grow. So the right way to do it is to come over here to employees, pay taxes, and then pay your liabilities this way. And of course, this is a sample file. So, oh wow. Looks like they have some overdue liabilities here.
Mhm.
So you're going to want to find them this way.
Is there any problem with the way that QuickBooks comes up with the cost of goods sold?
It depends.
It seems
depends
that
on
we
if you
always have
have-
this issue at the end of the year.
Oh, really? Is your inventory set up properly?
Probably not, but
Yeah, that's probably where the problem is. So in order for cost of goods sold to function properly through invoicing, the first step is to get that inventory list accurate. If your inventory list isn't right, it's not going to record, like when you invoice, it's not going to take your items out of inventory and record them as cost of goods sold properly. And of course, if you buy stuff and just put it all in cost of goods sold, that doesn't necessarily mean that you sold all of it. It just means that it's sitting in cost of goods sold. So you would have to decrease your cost of goods sold and put some of that in inventory.
yeah, every year I have to do some adjustments to cost of goods sold because when I look at it at the end of the year, I know it's not right. And I just go, we import containers, so I can easily go back and calculate manually
Yeah.
the cost of goods sold.
Yeah. So where you should probably start with that is this inventory number.
Look at the inventory and how it's set up. Okay.
Yeah, because they're related, they're connected. So
What's the right way to set up?
the right
Maybe
way
you
to
could
set
go-
it up.
Maybe you could go over inventory, setting up an inventory item. Maybe I just don't
Okay.
understand how to set it up.
Okay.
I could do one so I could see what has to be done.
Okay. So you would want to go over here to list. And then you would open up an item list. And this is where we'll set it up. So you can come down here to item, new item. It's going to be an inventory part. It's going to be a container. And you can do a part number if you'd like. So let's say the cost to you is $5,000. And let's say your preferred vendor is Containers. Okay, we're gonna set it up as a vendor. Okay, so then your sales price. Let's say your markup is 20%. So $6,000 for your sales price. It is taxable.
Our goods are not taxable, so I don't know if that makes any difference.
They're not taxable?
No,
Okay. So let's
everything we do is
non-
wholesale.
Oh, okay. So non-taxable. Our income account is going to be, let's see, let's do sales. Oh, well, this wouldn't be retail, it would be wholesale. But let's use this for an example. Okay, so wholesale sales there. Okay, so our asset account is going to go to inventory. And on hand, we have none, right? So, okay, so there we go. We set up our inventory item. So when we come over here to vendors, we're going to enter a bill from Containers or Us. We are going to have an item over here on this tab. We're going to have an item. We're going to buy a container. We're going to buy one. Okay, so then what this does, this is going to add that container to our inventory. So what this just did was credit accounts payable to Containers or Us, and then it debited inventory. We have one on hand, and there's our price, $6,000. So now we're going to go over here to customers. We're going to create an invoice. We're going to sell one to Adam's Candy Shop. They have a lot of candy to store. So we're going to have one container. Okay. So the price is $6,000. It's non-taxable. Remember, we set it up as non-taxable. We're going to save and close. And I don't want to apply those credits. Okay, so I'm going to go over here to my profit and loss. So that was dated 12/15/24. Okay, so let's see, where's our cost of goods sold? Okay, I think that was 12/15/24. Let's go back and check that. Oh, because I'm on cash basis. See, I haven't been paid for it. So I'm gonna go over here to accrual. There's my container. So I sold my container for $6,000 and I have my cost of goods sold for $5,000. If I look over here at my balance sheet, let me just double click on the inventory account so you can see what happened. So we're gonna look at it from 12/15/24. Okay, so see, when we bought it, it went in there, it debited inventory for $5,000. When we sold it, it took it out at $5,000. So
Okay.
see, when you set up your items in inventory, billing and invoicing kind of does everything for you. And then
So
when you
the
go here,
cost of goods sold has nothing to do with freight or duty or any of this type of thing.
yes, you would have to, when you do your bill, you would have to receive your items. Well, it should go into the item cost. So probably
Would
when
it be
you,
sub-accounts?
yeah,
When we show freight separately and duty separately, does that,
that's right, it would be. You would have it additionally here in your item list. So you could have another item for freight and another item for duty.
would that all then add into cost of goods sold or?
It would.
It would.
So let's say we add up another item. Oops, that's my chart of accounts. Over here to this. And let's do Control N for new. This is going to be a non-inventory part because it's well, let's go to other charge actually. But you know what? It's all part of the cost of an inventory. So let's call it inventory. And this one we're going to call freight. You could have it
By
be,
freight, I'm talking about ocean freight and import duty, not domestic freight. I don't know if we have to make a difference there.
you could set up two different freights to track them easier. And you could have it be, you could either have it be a sub item of your parts, or you could just leave it as freight. It depends on whether or not you want to tie it to containers versus another part that you have. So let's say you just want to call it freight, and then the cost of the freight. And you can always change this on your bill. Let's say it's $50, and let's say it's $500 for that container. This is going to be non-taxable. Okay. So this freight is going to be $500. You're not really going to sell it though. So we're not going to worry about the sales price. Okay. So we can put this over here too in retail sales. Okay, so it's going to go into inventory like this. Okay, so let's go over here to customer or bills. Okay, so we're going to go to containers. We're going to have our container. We're going to buy one. And then we're going to have freight. And it's going to cost us $500. So now this is $5,500. So when we save and close this, it's going to increase our inventory by $5,500. And then when we go to sell it, let's see, customers, invoice. So are you charging your customers for that freight?
No, what happens is we'll buy, you know, a container of product. It's not just a container, but it's a container containing maybe 5,000 pieces of a product or
Okay.
multiple products.
Wow.
And then we, you know, our freight for that container may be $2,500.
Mm-hmm.
So then somehow to get cost of goods sold, it seems like we have to amortize that freight into the products that we're bringing in. Now, I can do that manually
Well.
because everything's on a pallet and I know how many pallets are in a container, and so I can figure out the freight per item easily. I know it doesn't sound easy, but it is. You know, say for instance, there's 10,000 pieces on a pallet. Well, there's 20 pallets and that container cost me $2,000. Then I can just divide the cost per pallet by, you know, that. But that's a manual way of entering the cost of that product into cost of goods.
Yeah.
And
I
I
almost
think,
feel, oh, go ahead.
no, I think that may be what's messing us up on cost of goods sold.
Mm-hmm.
We get into this discussion with our CPA every year.
Yeah.
The Quickbooks doesn't do right on that. So
Yeah.
that's just a reference on it.
I guess my question is, as these containers come in, we have, say, 30 items that we do this with. I could easily calculate our landed cost for
Mm-hmm.
each of those items. And when the girls enter the goods as it comes in out of the container, they could enter that cost,
Mm-hmm.
opposed to what's on the invoice, which was the cost in Taiwan.
Mm-hmm.
You know what I'm saying? The cost in Taiwan might be $5. When we land it with duty, it may be $5.75. And I
Okay.
guess I could set up, you know, 30 prices for those items to be entered as cost of goods.
Yeah, I almost feel like, I don't know that I would set up a separate inventory item because you're not passing that on to your customers. It almost feels like it should just be included in the cost of the container. So when you go to vendors and enter bills,
Well, in effect, it is passed on to the customer. I mean, there's
because
several
they're
ways.
price
You can say
increases.
it's passed on to the customer in the price, or it's reducing our margin, or
Yeah.
you know, there's several ways of looking at that. But
Yeah.
you know, when I price it to the customer, I include all of those. I do my own calculation and include that before I sell it.
Yeah. Yeah, but you don't want it to go to cost of goods sold until you've sold the item from the container. So it seems like all of those costs should be included in the cost of the inventory with the container. So, and I would want it to be tied to the container. So it seems like you would want to have a container and then have the actual cost be here. You know, like if you get the one container of 30 items, I mean, you would have like 30 items. So it would be different than this. But I would include all of those in what it cost me because I wouldn't want to put it into cost of goods sold until the item is sold.
Yeah, that is a problem. That would be a problem.
Yeah, so I would just include it here. When I'm adding it to my inventory, I would include all of that cost into this item because then this item at all of its costs is going to sit in inventory until I go and sell it. And then when I sell it, it's going to hit the cost of goods sold the way it should. All, you know, it's not going to have like, instead of having $5,000 for a container in inventory and, excuse me, $2,500 in cost of goods sold before your item is sold, it's going to all go together.
Yeah, in the end, it comes out correct, but you're right. As an annual
timing
thing, it
difference.
becomes, you know, we're carrying the cost of.
Yeah, it's a timing difference.
So actually, you could expense out the freight, you could expense out the duty, but you don't want that built into your cost of goods. Okay, I think that's what you're saying, correct?
Well, I would actually keep it all in inventory. I would keep the freight and the duty in inventory. Because if you think about it, like buying a vehicle. So when you're buying a vehicle, you buy a truck and you put the truck on the balance sheet at what the truck cost you. So let's say the truck was $25,000, but it really cost you $30,000 because you paid tax on it and you paid fees on it. So you're going to put the truck on the balance sheet at $30,000 instead of putting it on at 25 and then having 5,000 of expense, because it all goes into the cost of getting the truck. So with the container, I would put it on the balance sheet at the price of the container plus the freight plus the duty. So instead of just having the cost of the container, I would put all of that here in the cost.
So then, as I said, I would come up with a calculation for each
Yeah.
of those items in the container,
Yeah,
including freight and duty.
exactly.
Okay,
Yeah, and then it will go to inventory correctly. It'll go to cost of goods sold correctly. Yeah, so I think that would be the best thing to do.
We can try.
okay.
We can try
There's
later.
a little more complicated because we buy in local currency in Taiwan and
Oof,
that fluctuates daily. And but I
goodness.
think what you're saying helps a lot. I agree.
Okay. Okay, so if nobody else has any questions about desktop, we should probably move on to online. All right. Okay, so I'll get out of there and stop sharing my screen for a minute. Okay. So let's go over here. Do you guys still see my screen or just me?
Oh, yeah.
Only you.
Oh, me? Okay. Okay, so let's go back in here. Okay, it's gonna make me sign back in. Okay. Go over here to sample. Okay, so we're here in our sample. Let me go ahead and share my screen again. What is that one? Okay. Okay, so now you guys see the QuickBooks Online.
Yes.
Okay, cool. Okay, so here in the dashboard for QuickBooks Online, let's say you have your company here. Let me get out of this. Okay, so here's your dashboard. So when you first log into your company, you're gonna have just a brief snapshot of what's going on in your file here. So you're gonna have your invoices, what you need to pay, you're gonna have expenses, and then over here to the right, you're gonna have your bank account information here, which is really helpful because you can jump right over here to your bank feed. So in QuickBooks Online, you can download your transactions. And then once they're downloaded, you can just come over here and match them or receive them. And it's very helpful because then, like I said before, when you go to do your bank reconciliation, they're already cleared off, which can make things quite a bit faster. So with the bank feed, you need to be really careful because if you have invoices in your file, if you don't match them, it's going to duplicate your transaction, which can lead to a nightmare for your accountant.
And you.
I know this from experience. Okay, so when you have your invoice, just make sure that you match it instead of just receiving it. So when you go here, you can find the correct payee, you can find the correct account and add it. So one thing about QuickBooks Online, it can kind of memorize transactions. So let's say this really isn't Books by Bessie. Maybe this is some other customer that you have that also paid you $55. You need to be really careful that you're receiving the right thing here. Okay, so that's the bank feed. And my biggest caution, did you have a question? Okay, so my biggest caution here is just please don't duplicate transactions. Just make sure that you're receiving them the correct way. And if you have any questions, probably just leave it open and have your accountant help you receive it so that nothing gets duplicated. So another good thing that you can do, because sometimes depending on how you receive money and stuff like that, sometimes it's easiest to not receive the downloaded transaction. So if you don't want to add it in, you can always exclude it over here. So instead of accepting it and matching it and receiving it, just exclude it. So that's probably something that you could talk to your accountant about too. That can sometimes help avoid duplication. Okay, so QuickBooks Online, you can go over here to this gear. So this gear has a lot of really helpful links. So this gear is where you're going to find your list, like your inventory list, here are your products and services. You can set up recurring transactions, let's say for your monthly depreciation expense if you have it set up. You can modify your account and settings over here. So one thing that I really like to do under account and settings is to go here. Okay, so with QuickBooks Online, of course, it's a live file. And it's very easy to do an entry and mess up like a prior period or something like that. So once you're done with your month or your year, you can always close your books and then set a password so that it warns you before you enter a transaction, so that you know you're not messing up your current month or your current year transactions. This is also where you're going to turn on your classes and your locations down here. And then where you enter your company information over here. Okay, so the reports over here are on the left. So this is where you'll find your balance sheet, your profit and loss, your accounts receivable, your accounts payable. There's also payroll reports if you have payroll set up. So this is where you'll find all of those reports in this one section here. Something that's really neat here, which you can also do on the desktop, of course. Let's say you want to create a special type of balance sheet. So you can come over here and customize it and maybe add a row for the prior year so you can see the change. No, not that one. Okay, and we want to see our change. Okay, so you can always save this and add it to a new group and call it annual reports, and you can choose to share it with whoever you want. Okay.
How many years can you build into that report? Is it 2 years or multiple years?
Well, you would want to look at it for, you can look at it for any period that you want. So
you could do 3 years comparison to show your growth and or your expenses.
It only goes up to the prior year.
Oh, okay.
Yeah. It'd be so nice if you could do a couple years, but it only does just the current year and then the prior year. And then you, of course, can filter it for customers, vendors to quickly find something. So this search is really helpful if you want to find a payment.
Comparison this year to last year.
Yeah. And then another thing about QuickBooks Online. So remember before in desktop, how I like to have all of my windows open? You can't do that here. So if you want to have more than one window, what you have to do is come up here and duplicate your tab. That's the only way that you can have like a balance sheet open with a profit and loss at the same time. So that is one drawback to online. So if you want to find something, you can go over here to the search and do advanced search. And then you can find something by an amount or a person. This is really helpful when you're trying to find something in QuickBooks. For a desktop, if you just do Control F, you can find stuff that way too. So, you know, you can find whatever amount that you're looking for here. If you're trying to find a payment that you wrote for, let's say $500, you can quickly find it there. So let's see your reports. Does anybody have any questions about QuickBooks Online? Has anybody used it and had any kind of troubles with it or anything you don't like about it or do like about it.
What about security?
Well, the security would just be the login. So
Okay,
this would just be over here. So you would be able to manage your users here in your accounting firms. So, I mean, all it is a login. It's online and you log in and then you have access to the account. So I can definitely see your point there with
Okay.
security. With desktop, it's just on your computer. So the only way that somebody could get it that way is to hack into your computer and get it.
right, yeah.
So it is something to think about. I've never heard of anybody having a security issue with their QuickBooks file, but it's the internet, anything is possible. So this is where you would set up an accounting firm. And this would enable your accountant to log into your file and be able to look at your profit and loss or your balance sheet or your transactions or do anything that you would like to do in here to help you. And one really good thing that QuickBooks has is an audit trail. So see this audit log here under the gear? This is really helpful because you can see who has been in your file. You can see what they've done. And this can be really helpful if you want to go back and see why something changed or something was deleted, who deleted it. That can be really helpful there. Let's see what else. To do the bank reconciliation here, you go to the gear. A lot of things that you're going to need to do are over here in this gear. You can do your bank reconciliation here. And, you know, this is a sample file, so it's kind of limiting. But you would just go here and do start reconciliation. And so this is where your items that have been downloaded and matched from the bank, this is where they would be checked off. So when you're doing your bank rec and you have something that's not cleared, here too, just make sure that it's not old. Check the date and make sure it doesn't need to be written off because it's very helpful to write off stale transactions in the current year instead of going back to prior years. All right, and see over here on the plus tab, this is where you're going to create your invoices or write your checks, do your payroll, record your deposits. So anything that you might not find on the gear, kind of your daily transactions are going to be over here under the plus sign. You would set up employees under here through payroll. And of course, you'd have to have the subscription in order for this to become active. You also can set up your 1099 contractors over here. And then every time you pay your 1099 contractors, it'll keep track of them so that when it comes time to do your 1099s at the end of the year, it should be pretty straightforward.
Angelina, I hate to keep taking up all your time with questions, but we have one issue with QuickBooks. When the customer sends in a PO and we enter it, we can duplicate the purchase order. And there's nothing in QuickBooks, it seems, that comes up and tells us, hey, this is a duplicate. Hey, you've already done this order. And so we have occasionally had problems, particularly with some employees who don't pay attention, of sending out duplicate orders to customers. Is there any way of setting QuickBooks up so that it will flash at you or call you a dummy or something if you enter the PO twice?
You know, I don't know offhand a way to do that, but I could definitely look into it and see if I can find an answer for that. It's a great question.
Yeah, it is a serious problem. I mean, it's not something that just happens once in a while. And I know you should probably look in the customer and see if that PO exists before you process it, but you know.
Yeah, but that's not always going to happen.
Yeah.
It just won't. I can see how that could not always
It
happen.
happens getting more and more because everybody, they send the purchase order by email. The email, sometimes they send twice. And then you don't pay attention, then you just punch it in the sales order twice with the same PO number. But the QuickBooks cannot tell you if it's the same PO, it should be able to tell you, oh, this is the same PO.
It seems like it would tell you this is a duplicate number because when you write a check, if it's the same check number, it says, are you sure you want to, there's a duplicate check number. Are you sure you want to create this? So I'm surprised there's not for a PO.
Yeah, I mean, it doesn't seem like a difficult thing to do. I can set it up in Excel so that it comes back and says, hey, dummy, or something like that, but it would be nice if QuickBooks would be able to do that.
Yeah, and I wonder if there is a way to do that. So I'm definitely going to look into that, and I can email you guys back what I find.
That'd be great.
Okay, what is your contact information?
Your email address is jt4310 at gmail.com. J is John, T is Tom. jt4310.
JT3410.
4310.
4310.
Right. At Gmail.
And actually,
JT4310 at gmail.com.
Yes.
right. I know you're going to get tired of this, but I have one more question. We have, how do we set it up so that, for instance, if I want to run a sale on a product and send it out to all my customers and say it's a 10% discount?
Okay.
I know it can be done. I just don't know how to do it in QuickBooks.
Yeah. So I know you have desktop. So to do it on QuickBooks Online, you would go here to the account and settings, and you would set your discounts over here under sales. Okay, so that section would be in here. And I think it might be something that's in an update because I believe that's pretty recent. Oh, here's the discount right here. Okay, so that's where you would set it there. Let me see if I can go back. Okay. Actually, let me share my screen here.
You could do it by all of the customers. And then it would take, hopefully would take their price and give them a 10% discount.
Yeah. Okay, so that would be customers. And I believe when you do an invoice, you can set a discount. I might have to look into that too.
Yeah.
I know it can be done, but because I
would.
use this as like a accountant.
It would be nice. I mean, we've got a limited number of customers, but they have different prices. But if we come out and send out an email to them and say, January 1st through January 30th, there'll be a 10% discount on this item,
Yeah, no, I know you can do that somehow, but I might have to look at it for just a minute. I thought it would be under invoices.
Well, maybe if you could get back to us on that.
Yeah, for sure. I could totally do that because there's definitely a way to do that. And I wonder if it's in the customers themselves. I just want to look real quick and see. Okay, so, yeah, it might be under here. Oh, there you go.
Yeah.
So you would set it up on the customer themselves.
So you'd have to go into all of your customers if you're going to give everybody a 10% discount then.
This is individual.
Yeah, that's individual, so.
Yeah. Yeah, I know that this is how you do it individual. Let me see if there's a way to just do it, blanket on your customers. Okay, so I will research that as well. Okay. Does anybody else have any questions about desktop or online? We have about 5 or so more minutes.
Another question is, if the customer, right now the customer sends the purchase order to our email, is there any way they can just go to our computer and type their purchase order in? The purchase order was the item, everything, they just come to your computer and give you the order was all the individual items. So we don't have to take the order, print it out, and then copy it to the sales order.
Yeah. I'm not sure about that one either. I know that you can create the purchase orders, but I don't know, like, so you want to,
Create it, yeah. Instead of
Yeah.
we create it, customer create it. That way will save us a lot of time and also duplicate.
Almost like an EDI.
yeah. I am not sure if the customer would be able to do that. I mean, you don't want a customer to access your file.
Yeah.
So, I don't know how they would be able to create their own purchase order without somehow accessing your file. And so you definitely wouldn't want to do that. It seems like something that you'd have to do yourself. I can ask, or I can look into that one too. I would think that that would be more possible with QuickBooks Online than with like a desktop
Yeah.
version, because that's logged out kind of just to you.
Yeah, sounds like online, maybe you can do that.
Yeah, I would think so, because it seems like you'd be able to share it back and forth more than desktop. So, but I will definitely look into that as well. Okay. All right, so let's see, we have about 5 minutes if anyone can think of anything else. I'm still sharing my screen. Okay.
End of the year, I think we talked about the balance sheet and the receivable. Anything else we need to pay attention or have to make a journal entry or adjustment before we give it to the CPA?
Sure. All right, so let's go back to this one. So let's see, you're looking at your balance sheet and you notice that your prepaid insurance, let's say you've used all of that for the year. So what you would want to do is go to company and do a journal entry and date it for the end of the year. And you're going to find your prepaid insurance. So that account is an asset. So it's going to have a debit balance. You're going to want to credit it. And then you're going to want to record the expense. And so that way you can go ahead and record the expense for the year and get it out of that asset account. So let's see what else. Mostly what we look at is we tie out the cash, we run through these accounts and make sure that they're reasonable, look accurate. We look at the accounts payable and the accounts receivable to make sure they look reasonable. And you're gonna also wanna reconcile your credit cards. And then we just check.
How about the retained earning?
Yeah, the retained earnings. So when you void a check, instead of making a journal entry, that's going to throw off your retained earnings. It's very easy in QuickBooks to write a check and have it be dated like July 1st of 20, so that would be 2000. That's going to throw off your retained earnings. So the retained earnings is the history of earnings of the company. Once you close your books and file your tax return, that needs to just stay locked, which is why I really like to lock the books when a period is complete, because it's so easy to mess this up. You could post a transaction in the wrong period. You could void a transaction. You want to make sure that this is not touched. And like this opening balance equity account, that's not a real account. That just means that an account was set up and they didn't know where to put the transaction, so it's just sitting there. So when you're looking at your balance sheet, you really shouldn't have this account. This opening balance equity, let's say that this file was set up. Let's say Larry had to come up with $151,000 to open this company. So this should really be owner's equity, not opening balance equity. So just watch out for that and double check.
That means the opening balance equity, we should make it always a 0.
Well, this should be called something else. It should be called like owner's equity or, like loan from owner or something like that. It's just kind of titled badly.
Okay.
Because see, here's owner's equity. It should kind of be down here because you can end up with a whole bunch of equity accounts that don't make any sense if you don't kind of keep an eye on it. Also, keep an eye on these bank loans. Make sure that when you went to pay the loans, that you didn't put the payment in expense or something like that. So if you get to the end of the year and these loans look really off, there's a good chance that maybe the payment went to expense. And when you're paying the loans, you know, the part of the payment is going to be a loan payment and part of the payment will be interest. So make sure you break out those portions of the payment as well. So if you wanted to,
How about the equipment, like what's that called? Equipment,
like when you buy equipment,
right? Like
Bobcat, tractor, forklift. Is that
yeah.
what you're talking about?
Oh yeah, the depreciation. That
Uh-huh.
part, we never know what to do with that.
Yeah, you would have to ask your accountant. So when your tax return is prepared, they should be able to provide you with a future depreciation report.
Okay.
So once your 2019 tax return is complete, they should be able to provide you with 2020 depreciation. And then you can just go ahead and record a monthly entry for that. And you can do that as a memorized transaction even, so that you don't have to think about it. It just gets entered each month. And then when you buy new assets, it'll go here under fixed assets. And you don't need to set up a new account for each asset that you buy. You can just have like one equipment account and one autos account, one office or furniture and fixtures. You don't need to have like 2010 pickup truck or anything like that, because this list can get just out of control if you do it that way.
So would you then set those up as to what their depreciation period is? In other words, if it's a home or it's a truck or a car, those things would be in subcategories depending on how long the depreciation goes for?
Well, I've seen that sometimes, but we certainly don't do that.
Okay.
We would just have overall categories, because when we do the depreciation reports, we put them in categories. So we'll have a report for equipment, or a report for furniture and fixtures, or leasehold improvements. We have like maybe like 5 major categories. We wouldn't have 15-year property or 5-year property. We would just have like the category and then record the depreciation.
We don't really touch that area. Seems like every end of the year it's the same number.
Oh, for the depreciation?
Never change. Yeah, depreciation never change.
No, it changes.
It would change if you purchase new assets.
So if you buy a car, that
Yeah,
number would change.
it would. Yeah, if you buy a car, if it's not a car that's like an equipment, like an equipment van, because of course that would be eligible for 100% bonus. And so you wouldn't. I'm sorry?
Say that again. Car is eligible for?
Yeah, like a van, you know, like a non-passenger van would be eligible for bonus depreciation, which would be 100% depreciation. So you wouldn't really record monthly depreciation for that. That would be more like a year-end entry that your accountant would make.
Well, what determines that is,
It's the asset type.
so if I go out and buy a $100,000 car, is that eligible for bonus depreciation or not?
No, that's more like a passenger vehicle. So that's going to have depreciation limits.
We're talking about company vehicles or equipment, I think.
Yeah, it's different. It just depends on what type of asset it is. So a car like that would have monthly depreciation that you could record.
Oh, well.
Yeah. I don't know with these $100,000 vehicles and the writing down receivables and stuff.
Well, can we just expense out? If a $20,000 car, we just expense out, don't even put it in like assets.
No, it would still need to be an asset, a fixed asset, because its useful life extends beyond a year. So the threshold for depreciation is somewhere around $2,500 on whether or not it's fixed assets or expensed.
All right.
Yeah.
Well, lots of information. I appreciate
We
it.
should do this once a month.
Yeah.
Yeah.
Once a month.
even during
Questions-
tax season.
questions-
That would be helpful.
Yes.
The questions were not trying to stump you. I hope you don't think we were.
Yeah. No, they're good questions. It'll be interesting to research them more.
Well, that one about the discount is becoming more and more important. We've never given discounts historically, but we're getting
Yeah.
into a time when we got old inventory and we'd like to start doing something like that.
Yeah. Definitely a different kind of year.
Hello.
Hi.
Hi. When will be your next session? Like, how could I know?
You could go to the Kent Chamber and look for events and see
Okay.
upcoming events. I don't have any more Quickbooks presentations on the books.
Oh, okay. Thank you so much. It was really helpful.
Good.
I
I'm
was
glad.
listening.
Thank you very much,
Really,
Amy.
really nice.
You're
Thank
welcome.
you very much. Have a great day.
Thank you. You too. If you
Bye
guys
now.
have any
Email.
questions, just email me and let me know.
What's your email? What's your
Perfect.
email?
It's so A is in Angelina, Evans, EVANS, at Shannon-CPAs.com.
Oh, you're in Kent.
Yeah, we're in Kent.
Right down the street.
1981, there was a gentleman who owned that. And you guys were right in downtown Kent.
Huh.
And he did some calculations for me on buying and selling. Anyway, that's
Nice.
been around for a long time.
This firm has been around for a long time. Definitely. We have a lot of really good people here, a lot of different experiences, and it's a great place to be.
Well, we'll look forward to seeing your name on the events calendar and hearing from you.
Well, thank you.
right.
All right. Well, thank you all. It was fun.
Hope you had as much fun as we did.
Yeah.
All right, bye now.
All right.
Thank you
Thanks.
very much.
You're welcome. Thank you. Bye.
Bye-bye.